Hey everyone, welcome back to Corporate Decoder, the place where we decode these complex financial filings to find the hidden stories and potential profits. Today we are diving into Mr. Cooper Group's latest quarterly report, and let me tell you, there's a lot to unpack, especially when a big merger is on the horizon. Before we get into the juicy details, make sure you hit that subscribe button and join our Discord community linked in the description below for even more exclusive insights. Alright, let's jump right into the numbers. Looking at their balance sheet as of June 2025, we see total assets standing at about $18.5 billion. That's down slightly from $18.9 billion at the end of 2024. A big chunk of that consists of mortgage servicing rights, or MSRs, valued at over 11 Ds, are around 13, the right to collect payments mortgage on loans, and they are a huge part of Mr. Cooper's business. On the flip side, their total liabilities are around $13.4 billion. These MSRs are basically the right to collect payments mortgage on loans, and they are a huge part of Mr. Cooper's business. On the flip side, their total liabilities are around $13.4 billion. Now, for the income statement. For the 3 months ending June 30, 2025, Mr. Cooper reported a net income of $98 million. That's a slight dip compared to $2004 million in the same period last year. For the 6 months, though, net income was down more significantly to $26 million from $385 million in the prior year. So while they are still profitable, things are tightening up a bit. Let's dig a little deeper into those mortgage servicing rights, the MSRs. Their value actually decreased from $11.7 billion at the end of 2024 to $11 billion as of June 2025. The report mentions that changes in valuation inputs or assumptions used in the valuation model MSR MTM caused a negative impact of heading $10 million for the first 6 months of 2025. This basically means that market conditions or their internal estimates changed in a way that reduced the value of these important assets. They also use derivative financial instruments to manage their risks. And as of June 2025, the fair value of these assets was $250 million. Derivatives can be tricky, but for Mr. Cooper, they are essentially tools to hedge against what could go wrong with interest rate changes or loan sales. Turning to their debt, specifically the advanced warehouse and MSR facilities, these total about $6.2 billion net of certain adjustments. This is down from $6.5 billion at the end of 2024. These facilities are crucial as they help finance Mr. Cooper's operations, especially when they need to make those servicing advances, which are like upfront payments they make on behalf of homeowners. They also have unsecured senior notes totaling nearly $4.9 billion. This debt is pretty stable from the previous year. It's good they're not taking on more of this kind of debt, though it's a significant amount. Let's look at how interest rate changes affect their business. As of June 2025, if interest rates were to go down by 25 basis points, which is 0.25%, their assets sensitive to interest rates would increase in value by about $26 million. But if rates went up by the same amount, their assets would decrease in value by about $60 million. For liabilities, the impact is smaller but still noticeable. This highlights how sensitive their business is to interest rate movements. Now let's break down their operations. Mr. Cooper divides its business into two main parts, the servicing segment and the origination segment. For the servicing segment, revenues were $436 million in the same period last year. This drop is largely due to something called mark-to-market adjustments on their MSRs, which took a hit. The overall unpaid principal balance, or UPB, of their servicing portfolio is massive. As of June 2025, it stood at over $1.5 trillion. This is a significant increase from last year, showing they are growing this core part of their business. The origination segment, on the other hand, saw revenues jump to $158 million for the 3 months ending June 2025, up from $107 million in the prior year. This growth was fueled by higher lock volumes and funded loan volumes in both their direct-to-consumer and correspondent channels. It seems like they're originating more loans, which is good for future servicing income. Looking at their debt again, the warehouse facilities used for originating loans actually increased from about $2 billion at the end of 2024 to $2.3 billion as of June 2025. This rise makes sense given the growth in their originations business. There's also a legal matter to keep an eye on, a class action lawsuit related to a cybersecurity incident in October 2023 was filed against the company. They are facing claims of negligence and privacy breaches. While the company doesn't believe it will have a material adverse effect on their finances, it's still something to watch for given the sensitive nature of customer data in the mortgage industry. And the biggest news looming is the announced acquisition of Mr. Cooper by Rocket Companies. This deal, valued at $94 billion, is expected to close in the fourth quarter of 2025. This merger could significantly change the landscape for both companies and how Mr. Cooper operates going forward. Now let's talk about Mr. Cooper's overall position. They still hold a dominant spot in the mortgage servicing market with a huge portfolio. Their servicing segment is generating steady but lower profits this year compared to last year, mainly due to market fluctuations affecting those valuable MSRs. The origination side is showing strong growth, which could be a positive sign for the future as these new loans get added to their servicing book. However, it's critical to note the impact of interest rates on their MSR valuations. Their dependence on these valuations makes them vulnerable to market swings. The upcoming merger with Rocket is a massive event that could bring new opportunities, but also integration challenges. The company's ability to navigate these changes while managing its debt load and cybersecurity risks will be key to its continued success. It seems like they are in a period of transition, and investors will be watching closely to see how the Rocket merger plays out and if they can maintain profitability amidst a shifting market. And alright, that's our deep dive into Mr. Cooper Group's latest financial report. What are your thoughts on their performance and the impending merger with Rocket? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more. And don't forget to join our Discord community linked in the description for more behind the scenes insights and discussions. Thanks for watching, and I'll see you in the next video.